Welcome. Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office. And for my members of SFO Continuity, a special welcome. Today, we're going to get right to it. Michael Cole on Inside the Minds of the $100 million Individual and Family. We're going to talk about investing, about lifestyle, about AI, about gold, about legacy, and what I would define as the fight for the future. So, Michael is really a special guest. He's been a big figure and a significant influence in the industry for decades. I kind of say what happens when you combine the man behind the family office practices over the years at Merrill Lynch, at Trust, at Abbott Downing, at Accent, at Crescent, and with the voice that's reshaping the super rich and what he's doing now. Well, you have Michael Cole is what you have. He also leads R360, the largest private network of centimillionaire families in the US. And we got a great show, a little bit more condensed than my normal 2 hours. So I'll have to move things along a little bit. But we're going to talk about AI, about SFOs and MFOs, about direct investing. We're going to talk a little bit about succession, power, and strategy, maybe a little bit of geopolitics. We'll see. But really, the centimillionaire and what moves them, what makes Michael unique in R360, something that I have a personal interest in, is longevity, health span, and really the future of human capital. On that note, Michael, finally, welcome to the show.
Thanks for having me, Angelo. It's nice to be here and excited to chat with you.
And Michael and I have a little bit of commonality. He grew up in Westport, Connecticut. I grew up in New York, but for about the last 14, 15 years, I live in a little community called Weston, Connecticut, neighboring towns. And me and Michael were reminiscing a little bit as we were leading to come on the show. So it's great to see him. Glad that we have that in common. Been a big fan for a number of years and look forward to getting into it. So why don't I start, Michael, if you don't mind, and it may be a little bit unique relative to we didn't do a preamble. We're just going into it. What's the biggest misconception that the families, the $100 million plus families, the centimillionaires have about wealth? They create wealth, they have an exit. Maybe they're giving it to a bank or a larger institution. Shouldn't they be taking who cares about their money more than them and about their legacy? What are some of the first steps they should be doing?
Well, Angelo, I think the biggest misconception that's out there is that if I'm successful at managing the money, then I will be successful in having a family that's a rich family. And in my nomenclature, I defined a rich family differently, which is a rich family is a family where they have wealth, but they also have family members that have a good sense of self-assurance, and they also have goals and fulfillment and purpose in life. And so if people focus only on the money, and oftentimes they think, gosh, I've now made all this wealth, life is going to be great, and I'm going to be happy, and my family members are going to be happy. Oftentimes they find that going through that transition, that wealth does not buy happiness, and that it often creates voids in life. It creates complexity. It creates some new challenges that they just weren't aware of.
And Michael, I'm going to bounce around a lot. So the UBS study on family offices came out about 3 weeks ago. It showed the number one concern, which has been now for 3 years running, and Goldman Sachs and JP Morgan effectively over their family office reports showed the same thing. And it's dear to my ears because my audience knows I talk about it a lot, and that would be geopolitics. It was, I believe, geopolitics number one, and broadly the economics number two. From a geopolitical perspective, your families of wealth, what are they concerned about, and how are they mitigating or hedging risk?
So that's a great question. Number one, they're concerned about the lack of consistency and the uncertainty. It seems like that it's very hard to predict what the future is going to look like because it's changing all of the time. And we're looking at on a world stage the issues around global relationships, around tariffs, around some of the hostile situations going on around the world create uncertainty, which impacts the economy. Now, what's interesting, Angelo, is that, we're looking at effectively almost an all-time high in our public markets at this point. But at the same time, when you look at consumer confidence and you look at GDP, it's kind of telling an opposite story. So, our members are concerned about risk, and they're looking at ways to mitigate that risk so that, that if a recession happens, when a recession happens, that they'll be prepared to make the right decisions and to set up their balance sheets in ways that take them through it in the most effective way possible.
How do you feel about, and I think I take a bit of a contrarian view than most people, and it's more than okay to disagree. My audience knows, oh, come on, if you're not disagreeing with Angelo, like something's wrong, at least at the end of 1 or 2 hours. That is the word wealth preservation. We're always told to get rich, you got to be concentrated, but to stay rich, you have to be diversified. I call what the young ones call cap, meaning a little bit of a lie about that. My concern is when you're too concerned about wealth preservation, you don't take risk, you don't keep up with your purchasing power, net of your distributions, your true inflation. If you're really rich, you're eating filet mignon, you're traveling, your inflation's not 3 or 4%. It's much more than that. You also don't encourage the rising generation to understand the value of how the world works, of calculating risk, of knowing when to hedge, when not to hedge. And you inspire what I call fear and a lack of courageousness in the family. Now, I think most people disagree with me. Angelo, they hit a home run. They should be in wealth preservation mode. You're irresponsible teaching them to be more concentrated. Nonetheless, how do you think? Are you somewhere in the middle or extreme either way?
Well, that's a great question. Let me give you the perspective of my membership community. Okay. So 85% of our members are first or second generation wealth creators. Okay. And oftentimes when they've created wealth, they've done it through taking risk, as you said. And when you're an entrepreneur, it's in your blood. So I would tell you that our members continue to be long-term thinkers. They continue to be risk takers, but they also are smart enough to set up their balance sheet where they use public markets as a source of wealth preservation. It's not a place that they make money necessarily. It's a place where they use it to manage risk and create enough liquidity to make it through difficult times. So, they're much more continuing to make direct investments. They do a lot of venture work. They do a lot of direct investments in real estate and operating companies and interesting ventures, but they do use public markets and they keep larger concentrations of marketable securities to offset the risks they take. So it is somewhat consistent to see more of a barbell strategy. Now, you can't place that across every member. That would be a wrong generalization. But what I can tell you is, our members continue to be risk takers, at least in a portion of their balance sheet. So I think my answer to you is somewhere in the middle. If you think that they're sitting there doing, a 60-40 blended portfolio of stocks and bonds, that would be a misnomer and incorrect. They're much more using public markets as a way to manage risk and to create liquidity to make it through volatility.
Okay, I think that's a fair and balanced approach. I agree. And I know you were a part of it, but to me, 60-40 is basically a fabrication of Wall Street. It gets people to allocate to invest, to allocate to their 401k plans. And that actually is a good thing. So if it is a fabrication that leads to, especially the majority of people at least getting involved in investing, then I'm not going to say that's bad. But I think for a family of wealth and success that has a level of skills that they acquired relative to understanding their portfolio. So there is, and I hinted at it earlier, and the industry usually vehemently disagrees with me on this. I guess I'm Mr. Outsider. And that would be, no one cares about your wealth. I come from a very humble background. I made money, I lost money, I made money, I lost money. Hopefully I'm on a made. Bitcoin was very kind to me about 10, 11 years ago. I'm of the belief, and again, I'm very type A and entrepreneurial, so maybe that's just me, that No one cares about your money like you. Now, that doesn't mean that I have the most skills internally to be able to manage that, but that does mean that I have the capability of acquiring the skill set and worrying about my money 24/7, which is why I structured via Lender versus the IRS my own family office. I have internal resources, and I'm very selective. I am an extreme advocate. My audience knows that, of the single family office. And we mentioned a fellow industry friend, Mr. McLaughlin, who my audience knows as well. He's an advocate of, if you're not effectively a billionaire, why bother? I'm like, Jamie, the world is changing. We have technology at our fingertips. We have tax advantages with Lender versus the IRS. And I go back to, I want privacy, control, and customization, and no one's going to care about their money like me. Therefore, I'm responsible for it, not someone else.
You want my response to that?
Yes.
So I think, Angelo, I fall in the middle. And it really depends on, objective, right? We have a lot of members that are what I would call quasi single family offices, where they have a few people that they employ directly, and then they outsource pieces of their family office needs or wealth management needs. We have other members that are complete delegators, and where they don't want the responsibility of running a family office, they don't want the cost. They want to work with somebody that they have a neck to grab, and that's their focus. We have others that have built, very significant staffed family offices and are in your camp, where they want the control, they want the privacy, they want the accountability of having their own team. So, it really does fall across the board in our membership community. If I had to generalize, I would say that you have the biggest group, or a group that have a few people that are direct employees of theirs, and then they outsource major pieces of their wealth management or family office needs.
Now, Michael, going back to the UBS report, and you kind of hinted at it, they are showing a decrease in private company transactions. They were broadly defining that as private investments, or including LP interest in private equity and venture capital, from 28% to 26%, with the advent it going to 22 to 24%. We all know the prior 2 years, the public equity markets have roared. This year is a bit more interesting. Are you noticing with your audience as well that they want the liquidity, they want the growth of the Mag 7 in AI and other initiatives, and they're kind of getting that in the public markets, where they have control to get in and out, they're controlling their fees, versus managers that are often asset gatherers that I don't have control. And again, as you could probably tell, I'm a person who likes control. Henceforth, are your people following a similar trend to me and what UBS is seeing, or you're seeing the reverse of that?
So, I think it's fairly consistent. I think our members are people that, when you've made your wealth by being entrepreneurial, you like the ability to have your hands in it and more control. You feel more confident when you can know the management team, when it's not subject to public market whims. And that doesn't mean that there isn't a percentage. All of our members have a percentage of their assets that are in public markets. But if you wanted to look at the aggregate, I would say it's a smaller percentage than they have in operating companies, in private equity, in venture, in real estate, and that, they're opportunistic. Now, the other thing I would tell you is that also, when you've developed, our average member is about 450 million in net worth. Okay. And at that level, one of the things we also see is a lot of secular trend investing, right? And people are, and so I think that is, and not even the next decade, the next 30 years, trends that are out there that are going to have impacts that aren't just today or tomorrow, but what are the things that they can invest in that are going to be changing the world over the next 2 decades?
Okay, so you give a lot for me there to work with, Michael. So I love it. So I agree. I like control. I believe I have an edge. when I invest in private companies, I believe there may be some alpha for me to obtain because they're less efficient markets. But if I want control, that means I have to have a pretty significant investment, possibly some rights, some board rights, and very possibly be a above 50% owner. I'm going to have to roll up my sleeves. And I think this could be good to also train my rising generation that the world isn't all passive, that you need to be hands on. But I do have some concerns over becoming an LP or becoming a minority investor where I have a lack of liquidity, I don't have control. And broadly, if I look at the markets, I'm not so sure that I'm going to do better than the public markets. And the fact that I don't have control and I don't control my net operating losses, I don't control my rising generation engagement. How do you justify, or your families, investing in private entities where they have no control versus control?
So look at it this way. I think of it, Angelo, as more of a spectrum. And the spectrum is when you're dealing in the public markets, for an example, you're at the whim of emotion to a much greater extent. And, because of that, you really don't have control of where the markets go. Your investment is not going to move the needle generally. And the advantage you have is you have the opportunity for liquidity. Now, what I see is the spectrum is that our members tend to be very discerning in the managers they select and the way they do private equity. And, where we were talking originally about this idea of, diversification. Well, I think that what we see in our member community is they're diversified, but with a more heavy emphasis to direct investments, to private equity, to direct real estate and private real estate, and alternatives, with a smaller amount that goes into public markets, where they don't see public markets necessarily as, in general, wealth creation. The public markets is generally for wealth preservation, and where there is real wealth made is by taking on risk capital. But the key is doing it in such a way where you are not concentrated to the point where you're putting too much all in one basket.
Okay. I mean, again, there's a lot there. And this is great, by the way. I love to have back and forth.
Sure.
Again, I don't mean to be, hopefully I'm not too prickly. Apparently everyone tells me I'm a difficult person, but I hope I'm not. But I want to go a little back.
No, you've been fine. I'll let you know.
I want to go a little back and forth on that. So I did a solo that Jeannie Buss sold to LA Lakers. So her father, the family, purchased it in 1979 for $67 million. They sold it for $10 billion. And I did the math. If they invested in the S&P, it would be about equal. But if they invested, if there was the NASDAQ 100, the triple Q would have crushed it by almost 3x. Now, I'm not factoring in net operating losses, creative tax strategies, and let's be honest, the feeling of owning the Lakers, of having a box, of the people that I'm meeting, that I'm inviting, I get it. It has intrinsic value that might be through the roof. But strictly from a financial perspective, me being liquid in the greatest companies on earth and being able to get in and out and not be tied into one entertainment company like the Lakers would have theoretically been the better option. Henceforth, I look at the markets and say, I'm invested liquid. I'm invested directly in some incredible companies. I'm invested in the triple Q. And I'm sorry, we have a contest and we look at it in 5 years and 10 years and 20 years. I am going to be more volatile. I'll give you that. I am probably going to beat you. I'm definitely going to beat 90% of venture capital, private equity, and hedge fund managers, net of fees and taxes. And I'm sorry, the math supports me and backs it up. Where am I wrong?
Well, I think what is key is mentality. Okay, so the question is that I think a lot of people that have created great wealth like the idea of being able to use their own creativity and their own entrepreneurial grit to find things that are interesting investments. Now, the bottom line with it is that, our investors and our members, they still are very well diversified. And, they still, as a rule, I think you could go but anywhere from 25 to 40% that would be in public market exposure. But the bottom line with it is that there's still that intrinsic value of working on things that you know, that you like, people that you trust. And I think that that's a big factor in a lot of ultra high net worth families, is that, it's not just about the investment return. So it's about all the other factors that are there. It's about, as you said, training the next generation, creating an entrepreneurial mindset, focusing around working with people that you trust and know, doing interesting things that stimulate the family in all sorts of different ways. So, and being smart enough to be well enough to diversify, where you're betting on things that give you opportunities in a number of different sectors and a number of different economic conditions.
And Michael, I was the first one in the family office world that I think developed put in the work, acquire the skills, had the gumption to move forward, and talked about, including when it didn't look good for me in 2017 and in 2022. I'm talking about my foray in 2013 and 14 and continuing into Bitcoin. The family office community, maybe not as much and I'll get to that in a second on the principles. Actually, why don't I phrase it this way? When I talk to people like that are the members of your organization, worth 450 million on average each, they actually get it. But when I talk to, this is a principal and agent problem. When I talk to the agent representing the family, they're far more guarded and careful. They're covering their ass 10 million times over, and it's easier for them to say no than to say yes. So when I spoke to principals about Bitcoin, oh yeah, Angelo, you make it make sense. Let's go. But when I speak to the executives, it was until spot ETFs came on about a year and a half ago, it was basically a battle that I was beating my head against a wall.
I'm in alignment with you on that. What I would tell you is that we are big proponents of Bitcoin, and our membership are big proponents of Bitcoin. We have several members that made their wealth in Bitcoin, where they went from having no wealth to being members of R360 because of Bitcoin. So we have very strong. We actually have some things we call circles, which are sub communities within R360 of affinity groups. One of those is crypto and DeFi. And so, we're big believers. What we also see is even those members that aren't, they didn't make their wealth that way. We believe there is a place for Bitcoin in particular and cryptocurrencies more generally in almost every portfolio, because it has a very logical place that it can sit. Now, the question is, how do you want to play it? Some people are bet the ranch on Bitcoin, and for the most part, they've done extraordinarily well. Others, are willing to put an allocation to Bitcoin because it fits into a smart risk management strategy and an opportunistic strategy. So, my answer is that we're big believers in cryptocurrency. We're big believers in Bitcoin. Our members are investors in Bitcoin, and some of them have made their wealth that way. So, we're not the other thing to tell you is, although I made my career being one of those financial intermediaries and, being 4-time CEO of multifamily offices, I know the rhetoric. But in the end of the day, Angelo, today, I'm with a bunch of people that are founders and entrepreneurs, and I'm not, we're not the intermediaries. We don't invest people's money. We listen to the trends that go on through our members.
I don't think we're going to go too much down geopolitical roads. This is actually going to be more of a Bitcoin and crypto question, but I have to frame it. We have a $37 trillion deficit. We have a recent bill that is going to be adding to our quote unquote, our challenges, our debt that we owe here in this country. Uh, who's buying treasuries? In the past, it's been mainly Japan and China, outside of course, American citizens and entities. To ignore stablecoins, to ignore Circle going public, to not be familiar with the players in the stablecoin space, how this administration is very, very pro crypto, and not realize that these major organizations in stablecoin are going to be the purchasers of US treasuries. We could argue that keeps the facade going. It keeps the fiat currency backed by nothing going for years to come. And of course, America as number one and the world reserve currency, Tether and others, USDC, that are involved in stablecoins. If you're an allocator and you're not understanding the basic math of stablecoins, and to me, you're not allocating broadly, at least to some degree in crypto and probably more so in Bitcoin, like, I don't get it. Now, you're agreeing with me, so we're basically on the same page here. But I have to put your hat on from a couple of years ago. You'll admit that the industry was very, very, very slow to adapt, and they were effectively wrong.
Well, and you know what I mean? Yes, I agree with that. What I will come back with, Angelo, on that is that, you know, you've been a watcher of the industry. You know, you are a advocate of the single family office community, which is awesome and the right solution for many. The issue when you're dealing with what we term MFOs today is that, you know, they're highly regulated and they're designed to be wealth preservation vehicles first and foremost. You know, when somebody goes to a wealth management firm or an MFO, the first criteria is mostly don't blow me up. And so their mentality is don't blow me up. So, you know, the bottom line with it is that, you know, that's the starting point and it still exists as the culture. Now, what does that mean? It means that they would rather be wrong and not take advantage of what would be an early adopter opportunity than take the risk of blowing up people given the place they play in the industry.
Yes, I mean, there is a saying that we're all familiar with, and this happens with people that are intelligent, that are well educated, but maybe a couple of decades has passed by. They have a level of success. They let ego get in the way. I believe in strong opinions, but weakly held. I believe in the belief of I rather be rich than be right. They would rather wait decades to think they're going to be right than to make real money. And I think where we'll also agree on, because we all know hedge fund managers, you know, I'm based in Greater Greenwich, Connecticut. When I ask them, oh, yeah, Angelo, that guy has a higher IQ than me. That guy's an economist inside my hedge fund. The guy can't invest. Like they're so frozen by too much data, by not making decisions. They're the furthest thing from a great Stan Druckenmiller as you could possibly get. And that sometimes is the challenge with a so-called expert, the challenge with maybe overeducation, with some things that have worked in the past. They would likely make terrible poker players. So for those even that play poker, you got to adapt. You got to be quick in the moment. But let me not get too far off track, Michael. Going again back to the UBS report. Shocking, although maybe not so shocking. About 1%, maybe 1 to 2% of family office allocations are broadly in commodities. That's not even factoring in gold, which meaning that's inclusive of gold. I'm sorry, which means most families probably have under 1% in a true allocation. To me, I would define that as physical gold. You are kidding me. Now, in European families and Asian families, that number is higher. In American families, that's not been the case. How are your families looking at hedging risk? The world is in turmoil. Currencies are effectively backed by nothing. Central banks are buying gold. Are your families doing the same thing?
So, I mean, certainly we have investors that are investing in gold, but I would tell you there are a lot of other areas that our members invest in. In particular, they're opportunistic real estate investors, and they look for stable long-term plays in real estate because it has traditionally been a good hedge against inflation. There's still opportunity in the right sectors for housing and multifamily. So we do have a lot of members that are investors in that. I think these are some of the reasons, Angelo, that our investors and members tend to be more direct investors, is because they do invest in things like cryptocurrencies. They do invest. We're also seeing trends where they're making investments that are international investments, but not just making investments in funds. They're making direct investments, and so I think the answer to your question is yes. They're investors in gold, but those are sort of what I would say to be traditional, somewhat antiquated strategies, and where there are, we're in a new world today where our investors have to be very thoughtful and smart about what are those secular trends that are going to really change the planet. Clearly, as a country, we're not going to get to success in operating the same way we've operated in the past. Things you brought up thematically, like cryptocurrencies, AI, humanoid robotics, are all going to be secular opportunities that have the chance to truly be game changers. And our members are really interested in those types of things. We just had we do 6 meetings a year in each one of our chapters. The last meeting we had a meeting we call our intellectual capital meeting. And it's all about what are some of those things that you're learning, or how do you create a culture within the family around intellectual growth? And we had 5 speakers come in. The speakers were about humanoid robotics. They were about AI and publishing film and music. They were talking about drones for commuter travel. They were talking about the changes in innovations in medicine, and they were talking about luxury or recreational space travel. And, it's interesting to hear some of these more secular trends that, used to be things that were in fantasy books or decades and decades away. And now our members are really starting to look at these things and see opportunities come about that they have the time horizon to be able to invest in things like that. So I really do believe we're to your point, we're in a world today where you have to be willing to take on risk, but it's intelligent risk. And the way you take on intelligent risk, it's about how much of your balance sheet do you allocate as risk capital, and what are the things in the time frame, and how do you think about liquidity to make it through volatility?
Well, Michael, yes, we did hint at it. You brought it up a little more forcefully than me, and my audience is going, Angelo, how could you be 36 minutes in and not bring up what appears to be the only subject lately that you ever talk about, and that is AI? So I do fashion myself as an investor in my own way, although I'm more active in public markets and obviously crypto. I consider myself to be more on the aggressive side. I don't see any, and I'm not the only one who says this, I get it, far more prominent people than me. I don't see where AI removes monopolies and moats. AI is going to be 64x more powerful 3 years from today than it is now. It'll be equally as important to the world as fire and electricity. The train has left the station. There's no going back. There's no guardrails, because China will surpass us and destroy us economically in every other way. That time might have been 2 or 3 years ago. It is gone. All roads in investing effectively lead through AI. That branches off into application layers, robotics, energy, biotech. I get it. And in my perspective, Bitcoin and crypto, but all roads. Therefore, I mean, easily 50 to 60% of my portfolio is very, very AI centric. Am I more volatile than the average person? Yes, I don't care. I have short-term cash needs met. I believe in a long-term perspective. If I have more volatility, I could care less. I'm looking at it in blocks of years, closer to 10 years out, assuming we still have a world to live in. Michael, Are your members a little bit more aligned with me from that perspective that now I'm going to bitch a little bit, I guess you could say, on real estate? I don't quite get it, but I didn't get it in my 60 years here on earth as much as other people do. Therefore, do you agree, or would you put a little bit of a cap on my agreement that all roads go through AI from the investing perspective?
It's a great question. I'm not at a belief at this point where all roads lead completely to AI. I would say that the world is absolutely going to be revolve around and either evolve or revolt around AI. Okay. So that I believe 100%. I think AI is going to change every industry. And I also believe, Angelo, that we are likely in an opportunity right now for the greatest wealth creation of all time, potentially, because when you think of the role AI can play in so many different industries, it is dramatic. Now, the question really becomes is how does society adopt to the impacts that AI will create on humanity? And we're having very deep discussions around that aspect of it. So there's one thing to say, is it the greatest investment opportunity and do all roads lead through AI? It's a fair question. But what also has to be discussed is what are the implications on greater society that AI will create? What will happen when things like long haul truckers are no longer needed any further? How do we as a society adopt to some of the changes? So, because of the nature of R360, Angelo, we are a community of what we call intentional wealth stewards. And we focus on 6 forms of capital: financial capital, which we're talking a lot about today, but we also focus on intellectual capital, social capital, human capital, emotional capital, and spiritual capital. So in our discussions around AI, one aspect of it is about the implications from an investment standpoint, but another aspect of it is what are the implications around jobs for our children's children, around how we evolve raising leaders, around how we invest and how we see society adopting in the way we do philanthropy that's going to be impacted by AI. So in a long-winded answer, I'm not far off from you in terms of all roads leading to AI, but I think more about not just the investment opportunities or risks. I think about what are the implications that will happen to all forms of society and what will it create as terms of opportunities for our members and risks.
I completely agree. Plumbers are very safe. Attorneys and financial services, I'm not so sure. And by the way, once robotics get better and better and better at the level I'm talking about, perhaps 10, 15 years down the road, then really effectively no one, including plumbers, is safe. Elon said there's a 10 or 20% chance, he appears to vacillate, that we basically summoned a demon summoning circle. I don't have measurables to state that, but I would state from my audience knows I'm really active in it. That probably feels about right. But that train has left the station. It is what it is. We're going to have to be incredible optimistic and do the right thing and make the most out of it. So, as I mentioned, I was very early in Bitcoin. I am 100x more behind what I'm seeing in AI from every perspective as it advents eventually to artificial superintelligence. And I feel in the family office world, Michael, I feel like I'm alone. Maybe not as much on the investing perspective. I have some people that are on board that train with me, but I look at it from a deeper perspective, like you, fashion ourselves to be intellectual. We know interesting people. We're naturally curious. And you see the exponential growth and you just realize, wow, what is my son going to do in 2 to 5 years? What is future generations going to do? And don't think that humans last well in a utopia. Psychological studies on mice, you give them a utopia living within a year or two, they're chaotic. As humans, we need to be challenged. We need to have a lion chasing us. That's what makes us incredible. Now, we could spend hours on a philosophical discussion. I'm going to slightly alter it relative to AI. that makes me sometimes hated by the industry, Michael. So let's go for it. No one is more active implementing AI in their family office than me. Effectively, I'm 100% effectively an AI family office. I teach master classes about it. I'm obsessed by it and immersed in it. I don't understand, and again, I'm a single family office guy. I don't understand how MFOs are effectively going to survive this. Like, I just don't see it. You're going to say the emotional hand holding with a client. I think AI inevitably in 2 or 3 years is going to do that better. And there's no way that a human is going to match the intellectual capacity when it's a million X what Einstein was. It's just not going to be able to keep up. Henceforth, why aren't more family offices adapting AI in their infrastructure to get an edge now? Because inevitably that edge will disappear as everyone's going to have it in a couple of years.
So, where we disagree is that when I look at the wealth holder of today, okay, the majority of people that still are in the control of wealth, they are mostly still people that are above the age of 50. And
in other words, they're old.
In other words,
including old. Me, I'm 60 years old.
Right. And Angelo, clearly, as you've described today, you are a more adaptive thinker than many people who are of a similar demographic. And so the issue becomes is I don't believe in 2 to 3 years that the average 60-year-old wealth owner will 100% trust an AI-based solution. I think that the MFOs and the wealth managers and even the single family offices that are going to be the most effective are going to realize they need a fraction of the staffing they have today, but that those frontline people that are connected to clients will continue to retain a role. And that role will be the family consigliere. There are things that, our members care about. They care about how do we conduct an effective family meeting and really dig into the emotional connection of the family members. And saying that an AI solution will do that effectively, I'm not in that camp, at least in the next 2 to 5 years. And not because the technology doesn't exist with the capabilities to do it, because the fact is humans still value human interaction. And so I think there is a role, but I think it's changing dramatically. It's not going to be an investment role in the same way it has been in the past at all. Right. But there will be a role for somebody that cares about, I'm building a family, that I want to build a family culture that survives over generations. I mean, think of our community, right? We have, hundreds of wealth owners that value so much getting together and sharing perspectives and experiences in the 6 forms of capital. And they want to talk about, how do you manage human capital within your family? What are the best practices? How do we facilitate workshops and have deep discussions? And, I may be Pollyannic, but I don't believe over the next 2 to 5 years that those roles about facilitating great discussions get turned over to AI.
I mean, broadly, Michael, I agree with you, but will you also agree on my side that even the significant $2, $3, $4 billion single family office, which is a world that I've lived in for decades, where they may have 17, 20, 25 employees, that is changing right before our eyes. I'm living through it. I'm going through it. I'm implementing it for families. We're going to have a very near future, if not right now, in a year or 2 from now, where that family office, assuming they don't have internal products to market and sell, could probably have 2, 3, maybe 4 employees and be just fine. Yes, they do need that consigliere, that trusted point that could connect with the family. Who knows what the decades out will hold, but in the relatively foreseeable future. But how is that not going to decimate the MFO, the SFO, the finance, the legal, the accounting industry? Well, there's no easy answer for this.
And, Angela, I mean, this goes back to what we were talking about a little bit before, right? It's not exclusive to those industries. It's every industry, right? And the fact is how will our society adapt to this? This is, a big question. When I think of my daughter, and I now have a 1.5-year-old grandson, right? And when I talk to our members about their children and their grandchildren, we're trying to figure out, what do you advise them to do? What careers should they go after? What will be the focus of mankind when maybe we're going from a hunting and gathering society to something different? So, your question about MFOs is valid. I do believe, as we've talked about, and you agree with, that there's always going to be, or at least for the foreseeable future, a role of counseling and connecting with families that will be there. And I think it's going to require the more evolving, smarter, revolutionary, evolutionary MFOs to be able to get there and do that in an effective way. Will they need as many staff members? Probably not. But the key is going to be is that how does all society adapt to these changes that are going to be going on? And in particular for our members, what do they do in terms of adopting their balance sheets, adopting the way their family operates, raising their children in affluence? What does all of that begin to look like? And those are the discussions that we're having, at our chapter meetings about what is this world we're entering.
I love it, Michael. That's fantastic. In a second, we're going to get to something more positive on longevity and health span. And I know you have to wrap up relatively shortly. I'm going to make a wickedly self-serving comment. For all the hate that I get from MFOs, whether as a board member or bringing me in, I'm the type of person, forget about all the groupthink people, forget about all the people kissing your butt. I will red team your MFO, and I'm not an MFO guy, I'm an SFO guy, and I will rip it apart and turn it upside down. And I might be wrong, but I'm going to cause you to think differently than you are now, because no one is challenging you. 90% of you are going to be toast. Well, not 2 or 3 years, I'll give you that, but within 10 years, you have to do something now, and you're getting a lot of legacy thinking in your industry, even more than mine in the SFO industry. But okay, enough about that. Let's be positive. I am extremely active in my health. I have a routine that I follow. I take a gazillion supplements. I'm a bit of a freak in terms of what I do. I'm incredibly interested, as your members are, in longevity and health span. Where I may disagree, well, of course, come on, Michael, I'm Angelo. I got to be a little bit edgy. The whole thing about, this wealth transfer of 84 trillion, 112 trillion, it seems to vary. I'm like, hold on, you might be right, but aren't we talking about AI? About biotech, about longevity? Don't we have Ray Kurzweil and others talking about living 150 years? Make it 10 more years, you'll live forever. Is there really going to be a wealth transfer, or are we going to have such breakthroughs in 10 years? Well, that transfer, because people love control, never really happens.
Well, this is a really interesting topic. And you get me off on, like you said before, Angelo, there's a lot of directions I can go with this, right? Let me start with this direction. So, as you can imagine, for our members, health, longevity, and wellness is one of the most important topics and one of the most interesting and most valued topics that we go into. And our members are at the leading edge of many of the longevity trends. It's our biggest. We have what we call circles, which are sub-communities within R360. And our health, longevity, and wellness circle is the most popular. And it makes sense, I think. If you've developed this level of wealth, you certainly want to live forever, because you don't know if the lottery is going to be as generous to you the next time. So, clearly it's important to take care of your health. Our members are very focused around health span as opposed to lifespan. And it's about being healthy as opposed to just living a long time. So that's been a huge opportunity. We have a very cutting edge opportunities and connections into the longevity community. That is one of the unique things about R360, because when you have a community of centimillionaires and billionaires, we get amazing access. So that's been incredible. I want to talk about something that you brought up, though, which is really important. One of the things we're seeing in a lot of our members is this question about, there's this journey where they've brought up their children, and there was this sort of anticipation that maybe at some point their children would be the wealth stewards of the future. And the question becomes a little bit where, some of these members will now be in their 90s or 100 and still going. And that means their children can be in their 60s or 70s and maybe never really got to be that entrepreneur that they wanted to be. So one of the things that we spend a lot of time thinking about is this idea of how do you create a journey with your children? How do you make it where it's not a wealth transfer, where one day it's yours and then someday it's theirs? As opposed to how do you make this a family enterprise effort where your children are being prepared and educated by doing this over time together? So, in the old world, it was kind of like this idea where the wealth is mine, go out and find your path, do your thing, struggle, make your own wealth. And someday, assuming that I'm no longer here, I will leave you whatever I leave you. What we're seeing a lot of today is the concept of let's make this a shared journey. Let's work together. Let's start to be investors in our children's future by preparing them, giving them opportunity through entrepreneurship, through philanthropy, through learning to invest, and be part of this journey, as opposed to what has been the old school way of it's mine and someday it will be yours. How about let's make it a shared journey where I, as the wealth owner, can get the joy of participating with my children?
I think that's an amazing approach, which is why you're so successful and providing great value at R360. Given my personal interest, and actually many of you saw me raise this cup and probably think I'm drinking a matcha, a green tea, a coffee, and I do all those things. No, this was my morning concoction. It was bone broth with beet powder and creatine. It really doesn't taste too good, but you gotta do, and really fresh virgin olive oil as well. So
look at you.
I'm telling all of you I'm 60. How do you know that I'm not 80?
Well, you're looking great. You're looking great. And those are the practices. I mean, what's really interesting, we do these health, longevity, and wellness retreats for our members. And we get some of the most incredible cutting edge practitioners in the space. And what's amazing when it really comes down to is it's not that complicated. When you look at what are really the key factors in preserving your lifespan and your health span, it's about, all the things we already know, right? Get good sleep, do a good diet, exercise, have community around you, take care of things in your life so that you're focused around living the right healthy routines. And it's become the mantra of our membership, and we take great joy in it. So I applaud you for doing those things. And what's been interesting around it is that not only do you look better, you feel better.
Have you had some of the Titans, David Sinclair, Brian Johnson, Ben Greenfield, either digitally or in person, or planned upcoming soon?
We've had many of them participate. David
Nice.
Sinclair has done many symposiums for us. We have just such an incredible group of concierge doctors. We have members we've been doing all sorts of different cutting edge events and treatments. We have a very tight relationship with the Buck Institute, which is the Center for Aging and Longevity in the United States. We have 2 members are on the board there. So this is a big focus for us. And we continue to focus in this area. And it's just, it's something that our members expect, want, and they get great value out of participating in all the different health, longevity, and wellness things that we do.
Well, Michael, I do want to be respectful of your time. Now, although we've been swimming around the industry for 20 plus years together, we finally connected. Uh, I'm a big fan of you from afar and what you're doing now closer. R360 appears to be amazing. I'm going to have a little bit of a close on my end, but sometimes being a gentleman when I'm not asking bombastic questions, tell us a little bit about R360 and how my relationships, whether they're members, people that listen, would benefit from learning about what you're doing as well.
Terrific. Well, thank you for the opportunity, Andrew, and thank you for asking. First and foremost, what R360 is it's a peer-to-peer community of ultra high net worth families, and it is a family membership. We don't sell any investments. We don't do any tax planning. We don't do any legal structuring. It is literally a community of peers that are focused around the concept of intentional wealth stewardship by managing 6 forms of capital. As I mentioned, financial capital, intellectual capital, social capital, human capital, emotional capital, and spiritual capital. What makes us so unique is we have 6 meetings a year, and each one of those meetings focuses on a different form of capital. I shared with you that we just had our intellectual capital meeting where our members sat around, and our first part of it was a roundtable where we had every member come up with a book, a podcast, a webinar, an app, a film that impacted them the most in the last 12 months. I walked away, Angelo, with 4 pages of notes, 9 new books, 4 new podcasts, and it's that peer-to-peer sharing that's an example of what we do. So it's a safe zone. There's only the principals of the families are involved. There's no family office people. There's no advisors. It's just simply the principals. And it's just become a safe zone for our members to be able to talk to like-minded peers in very vulnerable conversations. How do you live with purpose when money isn't a factor anymore? How do you raise your children to make them where they define success in their own terms? How do they live with the big shadow syndrome? So it's all of those types of things that we get into. And as I said, it's a peer-to-peer community. It's really a community. We've set up chapters around the country. And but when you're a member of R360, we have open chapters. You can go to chapter meetings anywhere. So super exciting. As I said, average age is 54. Average members about 450 million in net worth. 85% are wealth creators, and it's just taken off. And so, we've had a lot of fun. It's been a joy and a passion for me to get to work with such incredible people.
Everyone, Michael Cole is an icon in the industry, someone that I looked up to for his great work. We don't agree on certain things, but hell, anyone who agrees with me on everything, something's wrong with them. So I love that, Michael. And R360 is incredibly well regarded. I encourage my relationships, my listeners to learn more. Is there some crossover to what I do? Sure. But I think there's more. There's 9 billion people on Earth. In my case, I'm looking for 100. That's it. Incredible families that are usually more single family office centric to be a member of my private intelligence and single family office peer community. I've been in the very specifically single family office community for decades. Many of you know me as being the founder for many a year and CEO of Family Office Association. I sold it, created my own investment structures, restarted another group that I call SFO Continuity, which is way more intimate, targeted, and intellectual than anything that I ever did at Family Office Association. We're probably more so investing centric and areas pertaining to my love of geopolitics and macroeconomics. That doesn't mean that I don't enjoy lifestyle. I do. And obviously, I'm very health conscious, but I don't wear that on my sleeve in terms of my own intellect or value that I provide. I am a single family office obsessed individual. That is my focus. And really, if I had to bring it home, as you heard a little bit 20 minutes ago, I am all in on AI, not just from investing, but I look at it from geopolitics to society, and I'm all in on creating the family office, the architecture, the utilization, how it's changing everything from systems to talent to everything that causes a success in the family office. I'm the host of the AI Family Office Masterclass. Go to angelorobles.com and learn more. Michael, this has been great. I look forward to our future conversations. You're a wonderful team and intermediary, connected us. We were able to put this together. Hopefully we could have a direct connection. I love what you're doing. I'm a fan. I've been a fan of it when it launched a couple of years ago. I wish you nothing but the best. Have a great summer and look forward to next time.
Thank you so much for the time, Angelo. And the feelings are mutual. Have a great summer. Thank you.
You're very kind. Thank you, Michael. Thank you.